Well, hello and welcome to Moneycontrol. You have tuned into IPO Watch, and I'm your host, Nikki Mirchandani. And of course, we're on the sidelines of Tata Technologies IPO press conference. It's been a long-awaited IPO that we all have been waiting for. And of course, the one which comes from Tata Group stable after nearly 2 decades of wait. TCS was the one which launched on an IPO in 2004. Of course, this is the latest one that we have. The price band is in the range of 475 to 500 per share. The issue opens for subscription on November 22nd. And of course, it's also the much awaited one. But we are here to talk more about the company's uniqueness, the strategy, the financial parameters, and to take the discussion forward. We're being joined by the man himself, the company's CEO and Managing Director, Warren Harris, who's here with us. Thank you so much for taking out the time and having this conversation right at the sidelines. Start off with your uniqueness of your business model as compared to the other peers externally, KPIT, Science for that matter, or different mid-cap companies, but also within the group, Tata Elxsi. How different are you? Tell us more about your company's business.
Thank you ever so much, and thank you for the interest in our company. We're delighted to be able to share our story.
Pleasure.
Now we're a pure play engineering service provider, and we focus exclusively upon the manufacturing sector. There's really 2 components to our value proposition. One is product engineering services. So those are services that we deliver to our customers that enable them to deliver products to their customers. And we also work with those same companies to help them select and deploy the technology on which new products are built. What differentiates us is really 2 things. One, we are able to deliver services that extend to the turnkey responsibility for a discrete product, and specifically an electric vehicle. We have a portfolio of vehicles that we've developed for not just group companies, but for the entire marketplace. And the products that we've helped launch extend back more than a decade. So that complex engineering capability, that turnkey responsibility, something that differentiates us. And in order to be able to deliver that, one of the things that we have practiced is a balanced onshore-offshore proposition. We're not just an India out company. We are very much a global company. We're very proud of our position here in India, and the engine of our growth, the engine of our delivery capabilities is here. But we have 19 different delivery centers around the world. And we drive customer intimacy by being close and an extension of the customers we work with.
Well, the fair line of question that I wanted to ask, and of course, most of the community around, the analyst community, and perhaps even our viewers would want to know the line of how do you distinguish your company with Tata Elxsi, because the ER&D, how different are your customers? How different is the product line? Give us a fair sense of differentiation there.
Well, I can't comment on Tata Elxsi's strategy. I can't comment on TCS or KPIT's strategy. We all overlap in the broader ER&D marketplace. But the marketplace, the addressable space for engineering service providers like ourselves is about $100 billion. And it's growing at about 11 to 13% year on year. So there's more than enough opportunity for all of the different companies, not only to exist, but to continue to flourish and grow. We are focused upon building out our automotive capabilities. We are number 1 as accredited by Zinnov, an industry watch organization. We're the number 1 automotive engineering service provider in India. We're investing in aerospace, transport, construction, and heavy machinery. We are leveraging the turnkey full vehicle or full product capabilities to continue to differentiate us. And that's where we're investing. That's the difference that matters, that we represent for our customers.
Sure. I'm going to be playing devil's advocate here and perhaps ask you questions which seem to be a little bit of differentiation in terms of the revenue CAGR, right? For the last 3 years, the revenue CAGR that the company has clocked in is around 12%, which seemingly is behind the other peers, if I may so put it that way, except for Cyient. Tata Elxsi, KPIT all have clocked in revenue CAGR in the range of around 16 to 25 odd %. What explains this? How does the company plan to change that going forward?
If you look at the last 3 years, not the last 4 years, 2 years ago we grew the business by 48%. Last year we grew the business by 25%. When you look at the CAGR that you refer to, I think that includes the COVID impacted year of 2021. So our business has been growing at a commensurate rate to the rest of the marketplace. We benchmark ourselves against the likes of KPIT and Alexi and LTTS and the non-Indian players. And our growth rates are right at the top end of that comparative set. And we continue to be confident that we will continue to grow organically at a rate that is either commensurate or above the market growth rates.
So where do you expect the markets to be growing in the next 3 years, if I may put it that way?
Well, if you look at what Zinnov is positioning, they're positioning double-digit growth for the overall ER&D market here in India. We expect to meet or exceed those types of growth rates.
So that's going to be in what range? Do you expect to have the same range of 12%, 13% that you've clocked in the last 3 years, or you expect to kind of outperform your own performance that you've seen thus far in the last 3 years? Because the number seems to be a little bit on the lower side as compared to the peers. Probably could be the India exposure that is a little bit higher. Probably could be the automotive space, or maybe the education business, which is perhaps low margin accretive. How are you looking at it? What do you intend to change with all of this?
In the last 3 years, we've grown at a rate that is commensurate with the overall market. When we adjust for COVID, our business has grown at the top end of the comparative set. We are bullish about the future, but we do not provide guidance in terms of forward projections. And certainly, given the process that we are involved with right now, it would be irresponsible of me to give you a number. So.
Don't give me a number, give me a direction. Do you expect to sustain it, or do you expect to outperform your own number?
We expect to grow, and we expect to meet or exceed the projections that are positioned for the market.
Which is at what range for the market?
Double-digit growth.
Which is a high teen number that we're looking at? Do you have an answer? I mean, are you looking at a high teen number?
I'm not in a position to provide guidance.
Okay, so I'm going to leave it to that. But also, let's talk about Tata Motors and JLR.
Sure.
They contribute. 34% of your business revenue comes from these companies, and also are amongst the top 5 clients that you have. How do you intend to further bring down that concentration that you have from the group companies? Of course, you've done enough and more in the past years where the numbers have come down from 75% to 35%. Mm-hmm. The question really is, do you intend to bring that more? Do you intend to diversify more? And would you be allowed to work with other automobile peers too? Because it's a group company at the end of the day. So do you see that as a bit of a challenge at any given point of time?
No, let me make it very clear. There is no operational influence that the group, or indeed Tata Motors, positions on Tata Technologies. And so we are free to target and work with whoever we feel is appropriate in terms of the value that we can deliver. We expect the business at Tata Motors and JLR to continue to grow. But medium to long term, we expect, given the growth ambitions that we've got for the company, that the overall percentage that they will represent will continue to get smaller and smaller. Somewhat counterintuitively, however, over the next couple of years, we may see the contribution from Tata Motors and JLR actually bouncing up. Tata Motors and JLR have made very public statements about their capex and their investments in electric vehicles, both here in India and in the UK and places like China. And we are very much part of the ecosystem of partners that will help them deliver their product plans going forward. And so we're relatively bullish in the short term in terms of growth rates at Tata Motors and JLR. But certainly medium to long term, we expect the contribution in percentage terms of Tata Motors and JLR to come down.
By what percent? Now it's 35%. In the next 5 years,
it is actually at an aggregate level, it's 33%, and we expect that to continue to reduce.
So that's Do you intend to bring that back up 10% in the next 5 years? Is that a fair way
Again,
of looking at it?
I'm not going to speculate on the mix of our business or indeed the growth rates of any particular customer.
All right. Get your point there. But, automotive business has been thus far one of a significant contributor to the revenue. Talk about EV part of it. How much of contribution is actually coming in from the EV side of the business? What percent? How much scalable is that?
If you look at the number of electric vehicles that we are developing for our customers, and you look at just that business, that's about 30% of our overall business. So that's about 30% of our services mix. If you look at, though, the impact of electrification on all of our services, then the percentage influence is much higher. And what I mean by that is we don't just do turnkey product development for electric vehicle companies. We also provide offshore development centers. We also provide specific services that our customers integrate as part of the work that they do. Most of the investment in new product that the industry is making has some form of electrification. And if you look at the impact that electrification has on a product, the fact that you don't have to package protect for an engine, the fact that the battery pack is underneath the vehicle, the fact that the interior now is fundamentally different in terms of the driver and the passenger experience, that all drives the demand for engineering capability that will deliver that type of proposition, and we are intersecting with all of those things.
Right. Let's also talk about a couple of other financial parameters out there. Essentially, coming back actually to EV side of the business, because you say a lot of growth potential essentially comes also from that segment, right? At this point of time, if 30% is the mix of automotive, what percent if you could reiterate for me, comes from EV side of the business, you said?
No. If you look at our services mix today, almost 90% of our services is automotive.
Okay.
Within automotive, the specific contribution that our full vehicle proposition represents in the EV space is about 30% of our overall services, automotive services mix. But the offshore development centers, the services that we deliver as work packages to the work that our OEMs do, most of that work today is driven by the move to electrification, connected services, autonomous capabilities, and shared mobility propositions. Okay.
Let's talk about a little bit on your operational side, or let's just say financial side. The company's cash flow from operating activities from the financial year FY22 and the 6 months period, of course, ended September 30, 2023, has been negative. What explains that, and what can be expected going forward?
Well, the 6 months of this year is just change in working capital as we've invested in growing the company. But if you look at the last 4 years, and you look at an aggregate level, over 90% of our EBITDA is converted into free cash flow. And so we run a very disciplined and rigorous operations, and we expect to continue with that type of metric going forward.
All right. So you intend to be, for the next 6 months, you intend the cash flow from operations to be positive in that case?
Absolutely, we do.
Okay, all right. The company also, let's talk about the educational business out there. The company has recently expanded its offering from the educational business through IT platforms to public and private sector academic purpose out there. The share that we've seen has risen in the last 3 years from 1.63% to nearly 9% right now. What kind of margin profile does this business enjoy over your automotive business? That's one. And also, how scalable is the share of this business going forward?
Yeah, again, a great question. We've been in the business of training engineers since the mid-90s. We, in addition to doing product engineering, we also help manufacturing companies select and deploy the technology on which new products are built. So we do a lot of work in the PLM, ERP, and manufacturing execution system arena. And so in the 90s, we used to train engineers in the classroom. We then invested in an e-learning platform, I Get It. which we sell to individual engineers and also to enterprises. There are 50,000 engineers globally that subscribe to the use of that platform. And increasingly here in India, we started to partner with academia to address a very important challenge in India. India graduates about 1.2 million engineers every year, but only about 20% are deemed to be fit for purpose in terms of the industry requirements. And so we've been profiling a program called Ready Engineer that is focused upon readying engineers for the workplace as and when they graduate. That has given us an opportunity to influence curriculum. And 3 years ago, the state government in Karnataka approached us with a view to developing innovation labs that they wanted to deploy for the ITI colleges in Karnataka. And so we put together an innovation lab that includes the I Get It platform, but also includes manufacturing assets that will expose the student to smart manufacturing and Industry 4.0 capabilities. We've deployed those 150 centers. The Indian Prime Minister came and inaugurated those centers. And because of the success, we've had follow-on business with Tamil Nadu, with Assam, with Uttar Pradesh, with Bihar, and that order book continues to grow. What's exciting for us is the partnerships with the state governments and the academic institutions is further accelerating the content development for I Get It, which is further improving our competitive position in the private sector. So that business has grown well in the last 3 years. We expect it to continue to grow, and we expect a healthy mix of public and private sector business to inform the growth trajectory of that division.
So what kind of margin difference does this particular segment enjoy over the automotive?
The margin business at the moment is less than services, primarily because we have partnered with an ecosystem of organizations that provide the manufacturing assets that inform the innovation labs. But as we increase the contribution of the IP that we represent, as we increase the contribution from I Get It, for instance, then we expect that margin to improve.
Right. So the more volumes you bring in, better margin that you can have from the business. 9% is the share right now. How much do you intend to take it in the next 3 to 5 years?
We don't expect the overall mix to change. You know, we are at our heart a services business, and so that's the primary focus of our investments and our growth.
Also, why just OFS only? And the size has been trimmed, of course. Why not fresh issue? Why not why OFS at this point of time, and why not fresh issue is one of the questions.
You know, we debated this long and hard before we made the decision to IPO. But quite frankly, the business is debt free. We have a healthy cash position on our balance sheet, and when we look at our business plan for the coming years, we did not believe that we needed additional capital to be able to deliver the type of growth and capabilities that we are committed to. We think the IPO is going to be important to us, of course. We think it's going to legitimize us in front of our customers. I think it'll improve the trust that extends between ourselves and our customers. And I think in terms of brand, you know, we've got two markets that we serve, one for people and one for customers. And I think it will reinforce the proposition that we represent for both of those markets.
Right. One of the arguments also was why not probably consolidate or amalgamate, Tata Technologies for Tata Elxsi, something like that in the future is in the pipeline, because now clearly the company, the streaming business lines to an extent have been overlapping, like you've said. So why not just merge the two? I mean, that's the first line of thought that comes to anybody's mind when they look at this.
I'm not in a position to comment on Tata Sun's strategy or Tata Elxsi's strategy. What I can say is that the addressable space in the ER&D market is $100 billion. It's growing at a very healthy clip, double-digit clip. There's more than enough opportunity for all group companies and the entire market to continue to be successful. We are focused upon Tata Technologies. We're focused upon building out our differentiators, building the type of capability that's meaningful to the industry, not just today, but also in the future. And so we see this IPO as a further accelerant to that.
I'm also holding on to the strategy bit for a bit. 30% of your stake apparently was also under consideration to be sold to Warren Pincus, and that happened during the time of 2018.
Yeah.
Perhaps the deal fell off due to Brexit concerns, JLR being one of your top customers there. How different has the strategy been? Why that contemplation in the first place, and what has typically changed for the company over the last 3 to 4 years for that matter?
If you look at the journey that we've been on, we have raised capital for the shareholders and for the company at different stages in our evolution. The exploration with Warburg Pincus was very much a part of that. It was a decision that both companies made to step away from the partnership that we discussed. It was amicable. We walked away with very high respect and admiration for the Warburg team, but it has not impacted our strategy as a company. The strategy that we had in 2017 has been realized through the work that we've done since that time, and we think that the IPO will provide the type of support that we were looking to provide for our shareholders in 2017 when we were exploring the opportunity with Warburg Pincus. So, the capital structure of our business will likely continue to change, and we will continue to reference our responsibilities to the company and to the shareholders that we support.
Yeah, that typically is for Tata Motors, right? Which is trying to bring down the debt more so from the JLR perspective as compared to the Indian business, which relatively is debt-free, right?
Yep.
Okay, last question that I'd also want to understand from you, and it's an interesting debate which has caught an eye of a lot of people around, which is leaders like Narayana Murthy and Sajjan Jindal have made strong case of working for 70 hours a week debate. What do you have to say about that?
Well, I have some sympathy for what I think was underpinning the comments. When I've got 4 boys, I have 4 children that 2 are graduated and 2 are getting ready to graduate, and I always tell them in the formative part of their career, the important thing is to develop mastery in a particular area. You have to get good at something if you're going to build a reputation for yourself. And developing mastery requires hard work, and it requires a commitment of time to getting good at something. And so, I have some sympathy to the comments that were made. Whether it's 50 hours a week or 60 hours a week or 35 hours a week, I think that can be debated. But there has to be a commitment that a young person makes to getting good at what it is they decide to do in their careers.
All right, I think we're just going to leave it on that note. But thank you so much for taking out the time and having a conversation with Moneycontrol.
Thank you, Nikki. Much appreciated.